in this presentation, I'm going to go over three main concepts. First of all, what is the signature of option buying and what's the signature of option selling? What can be determined stylistically from these signatures? And then lastly, which active trading strategies share these characteristics? Broadly speaking, the two different types of option strategies that exist are buying and selling. Option buying normally entails risking a fixed premium for an unlimited gain. So that leads to a positive asymmetry of returns. It leads to negative time bleed. If the market moves nowhere, you tend to lose money on the position. And you also have a benefit of truncated frequency of large negative events. On the other hand, if you're an option seller, you have negative skew. You exchange a fixed premium that you've collected for unlimited risk. So if the market does not move, you're gaining day by day time bleed in your favor. But if you sell an option for $500, the most that you're going to make is that $500. But you can do that a number of times over the weeks and months using either weekly options or monthly options or longer dated options. So you have that positive aspect of positive time bleed, but the negative aspect of negative skew, negative asymmetry, and the possibility of profound losses on the position. So to illustrate these sort of signatures, what I'm doing is I'm going back to the example of 6 positions that we've sort of gone over in a previous video: bullish collar, long call, neutral condor, bullish strangle, ratio put, and ratio call. And I'm just looking to give more concrete examples of these characteristics that really we should see regardless of the market that we're looking at. So what I've done is I've just arranged a series of histograms which display the weekly returns of the bullish collars on the S&P and bullish collars on crude oil. So what you see if you look on the left-hand side of the screen, you'll see this evidence of this positive skew, positive asymmetry that was mentioned before. So you see relatively few occurrences of profoundly negative outcomes on any of the strategies listed on the left-hand side of the screen. If we move to the right-hand side of the screen, you see that negative skew that we were talking about. The more profound thing that actually shows up here, though, is the extreme peak around the small positive outcome. So on the left-hand side, we're seeing occurrences of relative frequency, sort of 20 weeks, 15 weeks, 18 weeks of returns around zero. When we go to the right-hand side and we look at the strangles, the ratio calls, and the ratio puts, we are seeing numbers like 30, 70, 60 weeks where you're making a small positive return. So that relatively higher frequency of small returns, that's the signature of premium collection. So if you see strategies that have small, very small but very frequent returns, you're probably doing premium collection. And other things being equal, you may also be exposing yourself to unlimited downside risk unless you're engaging in some sort of overlay or strategy which mitigates that possibility. On the other hand, if you see a situation where there are relatively fewer large negative outcomes and a few relatively large magnitude, low in quantity, positive outcomes, you're probably engaging in an option buying strategy. Okay, so what do these trading strategies characteristics, which active trading strategy characteristics are shared with the option strategies that we're looking at? So far what we've done is we have taken a particular product, the S&P E-mini futures, and we have turned it into a particular option index. So if we roll in the money calls, we end up getting a picture like we are at the extreme right here on the top. If we take the S&P and we roll ratio puts, we get an image like we're getting in the bottom here. So the long call should theoretically resemble a process similar to trend following, because trend followers tend to use stops. They try to be engaged in markets which are in a trend, but because they have to make a decision which markets are trending, they have the potential to be whipsawed, and if the markets don't move, they might be losing money. So those sort of stylistic facts link the strategy of a long call to the strategy that trend followers might be engaged in. On the other hand, a mean reverting strategy is one which tries to go against the trend, has a relatively high frequency of small gains, but a possibility of larger losses in the event that you end up standing in front of a moving train. So if you are selling into a rising market and the market does not mean revert, then you could end up with a largish loss. So the ratio put is basically a bet which is similar to the concept of mean reverting. So why does this matter? Well, it seems that a strategy like trend following, which seems to have had some to it, but has sort of known weaknesses, could be augmented by adding a mean reverting component to it. And with the TMQR EXO index, you can systematically do that now. So you can say, I want to have a core component of my portfolio, which is going to be trend following, but let's make some fraction of it mean reverting as well. And you can sort of know where that fraction of the return is coming from because you've assigned it to a particular EXO index. So that's one of the first implications that we see out of this type of analysis. So with EXO index, one can rest decisions on a quantitative base. And because you have a quantitative base, you can then pose and answer questions systematically. So you can shed light on issues which are not necessarily at once intuitive or obvious. So, for example, some people often say that they wouldn't engage in option strategies because buying an option is like buying a piece of melting ice. Whereas other people say that your odds are very good in options because they've looked at the data and 95% of the options that trade on an exchange finish worthless. So that's the argument for people that think you should be a seller of options. Both of those, to me, seem somewhat anecdotal. So what we were trying to do here is quantify those questions, or have a way to quantify those questions so that we can answer specific questions that are posed. So one of the questions that comes out of this that I sort of alluded to before was, what happens if you trend follow a premium collection strategy? So before, we were looking at an image in the previous slide of the ratio put, and we saw that it sort of had some nice characteristics, but it had swift and severe pullbacks in the window that we were looking at. But the trends were somewhat more stable and more defined than even the underlying S&P 500. The implication there is that an index like that ratio put index might actually lend itself to a trend following style of strategy better than even the S&P by itself. So now that we have the EXO indexes in place, we can answer sort of somewhat bizarre questions like, how has it worked out being moderately bullish of the euro? So often you hear pundits saying that they are bullish of the euro or bearish of the euro, but you don't often hear people speaking to the point of, well, I am moderately bullish something. Or if they are saying that they're moderately bullish of something, they normally would express that by saying that they have a 30% out of 100% exposure to something. The way that the EXO indexes work is there are particular nuanced views, and you can actually go and see how being neutral or moderately bullish a particular market, how it actually would have performed over a period of time. So that's pretty unique. What's interesting is that there's actually more than one way to be moderately bullish. We're going to look into that a little later. So the other questions that we can sort of answer now, can I limit my risk and increase my chance of returns with EXO index? So because we have things like the call index, or we have the collar index, or the neutral Condor, those are positions which have a limited static risk to them. So you can know when you go to bed at night that you are not going to lose in the next day, failing FCM failures, you're not going to lose more than the premium that you've put up. So that lets you tailor your strategies a little differently, use leverage a little differently than you would be if you were strictly using outright futures. Another idea that sort of can be addressed is, are the EXO indices, broadly speaking, more tradable than outright positions? So what we saw in previous slides was a potential for there to be more trendiness in some of the EXO indexes than there were in the underlying. So trend following strategies tend to like high serial correlation. And often various statistical tests of markets say that there isn't serial correlation in equity markets. Maybe there is in currencies and commodities, but not in equities. What we've seen in previous slides was that there seems to be serial correlation in equity markets. It's just you have to be looking at the right options structure to be able to find that. And so lastly, the question that we can address is, do EXO indices go into hibernation in the same way that CTAs who are engaging in trend following often say that futures markets often go into hibernation? There aren't persistent trends that are existing. And the sort of initial findings are that it seems that since there are so many variations in the EXO index, it seems like you've actually reduced the chance of having your markets go into hibernation on you, because you should have some alternative that you can turn to where a trend exists. So if the underlying is not trendy, it's possible that the neutral Condor index might be trendy, or if the trend is not to the bullish side, then one of the bearish bets, whether it be the bearish put, the bearish collar, or potentially a bearish strangle, could be exhibiting trendiness, which could be exploited. So those are some of the questions that we can now address, and we'll go through that now. Okay, so getting back to this earlier question of how's it worked out being moderately bullish for the euro, and what does that look like over time? So I've identified just in the EXO indexes 5 ways that you could express moderate bullishness to the euro. The ways that I've identified is the bullish collar, the ratio call, the ratio put, the bearish strangle, and the short call. So if we look at the far left here, you can see that the bullish collar has actually had quite a bit of volatility. Again, this is equalized into the same margin to equity as would be going on in a one lot on the euro. So 10% margin to equity in the collar position and 10% in the futures position. Much higher volatility in the collar in this testing window, but still a different view, a different look than the underlying market. Then if we move to the center of the page, moderately bullish. So the ratio call on the euro seems to have done quite well in this testing window. So it's up north of 30% in the testing window. Some severe pullbacks, but a definitely a different path than you're seeing in the underlying euro. The ratio put above that, again, some severe pullbacks, but definitely some exploitable trends, which are a fair bit different than the underlying euro. And again, these are all static positions in well-defined option strategies rolled continuously over time. So you always know what the position is, you always know the exposure, and because you know those things, you can then tactically hedge them should the need arise, or you can combine them into portfolios that have sort of risk-return characteristics which match your preferences a little more. Moving to the right now along the page, the bearish strangle. So you can see that one has really got a wildly different outcome than the euro futures by themselves. North of 70% for a period less than 600 days, but with pullbacks or drawdowns, although fairly short-lived, in excess of 50% probably. So if you're looking to trade that thing, there's a whole opportunity there, just because of the variation, probably more than there is in the euro. But because the euro is such a deep and widely traded instrument, it means that there's going to be a lot of capacity in this style of strategy. So the last swing at moderate bullishness that I took on the euro was the concept of the short call. What I'm showing you here in green is actually the payoff from a long call, because I don't have a short call index per se. But one can always go short of that index. And you can see that if one was to have done that, they would have had opportunities to capture swings in excess of 30 to 40% over that testing window. Again, so there are 5 different expressions of moderate bullishness. There's nothing that's unique about this on the euro. You could do this on any product where the options and futures exist and there's liquidity. But one thing that I think you'll see pretty clearly is that The level of correlation between these bets is not particularly high, and we have not left a single complex. We're all with every one of these trades is done within the euro complex. Getting back to this point of what active trading strategies share these characteristics, these are my stylized trend following and a mean reverting strategy. So in black is the trend following, in green is the mean reversion strategy. So stylistically, the trend following should have larger up moves when they occur in a single period of time. On the other hand, the mean reverting strategy should be able to exploit those periods when the trend following strategy is maladapted.
If you would like more information on the TMQR EXO indices, please go to www.tmqrexo.com. Over 100 option strategy indices on exchange-traded futures markets are updated daily. If you have any questions or comments, please email